Welcome to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. We've had a couple of days of weak price action, and I want to look at a few things together. We'll look at the price chart, we'll check out the spending behavior of short-term holders and what it tells us about the market. We'll look at the futures dashboard, and we'll also see if there's been any older coin spending on-chain. It's important to keep ourselves level-headed when we see price weakness and to test our thesis. So we're doing that today. If you enjoy this content, make sure you give the video a thumbs up and subscribe. This is the best on-chain community on YouTube, and we'd love for you to be a part of it. Almost 4,000 subscribers and growing fast. So let's get started. When we last spoke the other day, we were hanging around 64,000, and I was wondering if that would be the place we caught support. Well, I was wrong about that. We've seen a sell-off. We lost about 5K in the price. And we're now consolidating around 60,000. We're also clearly in a bit of a symmetry here with this channel that began at the end of July. And one cool thing about this channel, if we zoom it out here, you can see where it is. It kind of matches perfectly with this trend line that started in March of 2020. I always like seeing that kind of respect paid to past levels on price action. That stuff's always cool to me. But if we zoom in on this channel and we really look at it, the next level that I think would be important to hold is this spot right here, which is around 53,000. This level is September 7th's peak. This was the day that El Salvador made Bitcoin legal tender, and we got a big futures wipeout on this day, a massive candle that scared the markets. We covered this washout extensively in an earlier video, and I'll leave a link to that in the description if you want to revisit some history. But right now, just looking at it, this seems like a really important place for us to gain support if price doesn't hold up here. It could still come down and test this level without invalidating our bull thesis. And it is curious how this key level also matches up with the bottom of the channel. So you can see how maybe price could work its way back down here before a bounce. So 53K is a spot I would look for if price makes its way back down there. Don't know that it will, but something to note. In the last video, we talked about how there had been some spending of older coins older than 3 months, which you're seeing here on our spent volume age bands. This is all of the daily spent coin volume split up by the age of those coins based on when the time they last moved was. We had a spike in the middle of October as we broke the all-time high and we created a new high around 66K. There was an increase of spending of 3-month and older coins, and it has subsided. In the last couple of weeks, it's been a bit lower, only about 2.5% of daily volume, which is on the lower side. You can see in the bull market of 2020 what an elevated amount of volume from this group looks like. It can be 5, 7, 9, or even 10% of daily volume. Right now, we're not at those levels. See the decline? So in the last couple of days, there hasn't been a lot of older coins moving, but we did get some selling. This is the spent profit ratio of short-term holders. Just as a refresher, we have two main supply cohorts, long-term and short-term holders. When a coin sits dormant for 5 months, it becomes statistically less likely to be sold based on some analysis that we've done at Glassnode. So once a coin sits for that long, we consider it part of long-term holder supply. And any coins that are younger than 5 months, that are still changing hands frequently enough that they don't really age, those coins stay part of short-term holder supply. And some of those coins will stay still and mature and eventually join long-term holders. But what we like to watch, especially in the shorter time frames of bull rallies, is the spending behavior of the short-term holders, because their moment-to-moment profitability is what has a bigger effect on price. This black line across the middle is the break-even point for short-term holder spending. And keep in mind that these values on this line are only the outcomes of spent coins. Any coins that belong to short-term holder supply that aren't being spent don't show up on this line. But the ones that are moving around have a profit level of some kind. If it's positive, it's over the black line. If it's negative, it's below it. Let me zoom out a bit. Something you can see about this line is that it closely follows the strength of price. When price is strong and we're setting highs and rallying and bouncing around, short-term holder spending has a tendency to see higher values, that's more profit being realized, and then come back down and test bounces of the cost basis. And in many cases, new buyers will step in if it's a bull market and push price higher, and you'll see the line reverse and bounce up. But when weakness starts to enter the market, when there's not as much demand volume to sustain higher prices, or if there's an overhead supply that gets dumped on the market by a bunch of sellers, you can see profitability start to wane and it gets tested. When we had a big sell-off in May, the spending profit ratio of short-term holders dipped into the negative. And once it got down into this deep level down here, it took quite a bit of time before it was able to work itself back up into profitability. Every time they would spend some coins and get back up near their cost basis, some more sellers would step back in. There was still an appetite for selling. There was more willingness to exit the market, and we'd get price pushed back down. And so the market kind of battles around for a while. And eventually it catches some support. We get back into profitability. Some of these users are spending coins and actually seeing some gains for, in this instance here, the first time in a couple of months, from May to July. And then once we get into profitability, when we have a bull market, when strength has returned, we test our cost basis, buyers step in, and we get a bounce. And then price can continue to kind of rally and move for a few weeks as we bounce off this line repeatedly. And then sometimes we'll break down below it. There will be some loss realization and a bit of confidence gets shaken out of the market. In those instances, it may take a few days or even weeks to shake out all of the selling that needs to occur so the market can reset and move on to the next level. We got a little bit of that here in September. You can see some of these loss prints on short-term holder spending. And in these moments, price was showing weakness. But then eventually we caught some more support here. Confidence returned to the market and we got another rally. What I've seen here in the last few weeks, I'll zoom in a little more. We came up here in October and we set a new all-time high. Then we pulled back, went sideways, came up and set another all-time high and have since sold. Right? The spending of short-term holders was increasing into the rally through October, setting higher and wider ranges of profit prints. And then after we hit the all-time high, there was a bit of a pullback and short-term holder spending really got tested. They dramatically whipped back down to break even. There were some people spending at the margins. This likely happens, this swift downturn after the all-time high, because people bought the all-time high. A bunch of people bought into this rally. And as it pulled back down to their cost basis on the other side, they were getting out. They were spending their coins to get back out. They bought here and went, oh shit, it's not going to stay up here, and they got back out. What we've seen the last few weeks, lower highs. We hit this peak and we've not been able to see the same levels of profit spending from short-term holders. We're setting lower highs and we're now breaking down into loss realization. These last couple of days have really seen this print dip down below here. So what I'm going to be looking for is to see if we get a bounce back up into profitability. If we don't, we may be in store for a little period like this, like we saw in September, where it takes a couple of weeks of squeezing out a few of these people who bought up here, who got excited, who didn't quite know what they were doing, and they bought the top. And some of them are not going to stick around. We may need to shake them out in order to move up and have another leg, another sustained rally like this here, where we're bouncing off of break even. Here is the short-term holder profit and value. So this is not too dissimilar from the spending profit ratio of short-term holders. These two lines go together. Here is just the outcome of their spending and how profitable it is. This is the profit ratio of all of their coins currently held. And it's the ratio between their current cost basis and the market cap. It's the MVRV of short-term holders. Now, in a previous video called Back to the Beginning, I broke down how the MVRV works in detail, and I will leave a link in the description below. I recommend you check that out if you have questions. Just as we spoke about on short-term holder spending, spending catching a bounce off of the cost basis in bull runs, which signifies market confidence, we have something similar that happens with their MVRV, which, as I mentioned, isn't spending, but they're held coins. If you look here at the bull run in 2017, this orange line represents the MVRV of short-term holders. It's the ratio between this blue line, which is their cost basis, their realized value, and the black line, which is the market cap. In bull runs, the MVRV of short-term holders frequently tests break-even cost basis. We get rallies up, we get pullbacks that neatly test, find support here, and bounce back up into the next price run. Then we get a pullback in price, the MVRV of short-term holders tests the cost basis again, and off we go. In bear markets, in capitulations, price will get underneath the cost basis of short-term holders and find it as resistance for a period of time until the market is able to squeeze out this selling, reset, confidence returns, and we can get another rally. Over in 2020, in our most recent bull run, we had the same effect. There was the flash crash in March of 2020, the liquidity crunch that hit all markets that was a result of the economic response from the C19 sell-offs, had this liquidity crash. And in the recovery from that, this orange line, the MVRV of short-term holders, got back into profitability, tested the cost basis, bounced off of it, small rally in price, and we get a pullback of their cost basis as price continues to go sideways. And then right here, in this moment, it finds support. Short-term holders do not realize loss. Enough buyers exist in the market to continue pushing price up, and we get a rally. But that didn't come until short-term holders dug themselves up out of loss, were given opportunities to test themselves, the market found support, and we moved forward. A similar fractal is playing out now in 2021. So at the bottom of July, short-term holders were well in the red. They were underwater, and they dug themselves back up into profitability through the month of September. And in late September, just before the rally that really shot us through October, they caught a bounce on their cost basis right here. Short-term holder MVRV got a confidence bounce, and the rally ensued. We're now seeing them pull back down. Based on this dynamic, based on this history we've seen here and in this 2017 bull run, I didn't zoom out enough, and in this 2017 bull run, where they can push up during a rally and then come back to test their cost basis numerous times within a bull run. We may be seeing that same behavior over here. We may have seen a bounce, we got a rally, and we may need to come back down and test this level again. And right now, this level is at about 53,000. 52,826 as of yesterday. Well, 53,000 is this line that we just said was a key resistance point. It's the peak from September 7th on El Salvador's Bitcoin Day. That level, around 53K, perfectly matches the current short-term holder cost basis. And it's where short-term holder MVRV looks like maybe it would catch a bounce for the next leg up. This is a dynamic I'll be watching over the next couple of days, next week or two. I'd like to see it play out this way. If we get a confident bounce here, maybe it doesn't come back down to this level, but if it does, we would be looking for this action right here. If we see that, we see a reversal. We don't see short-term holders capitulate and start sitting in heavy loss like they did in the summer. If we catch this bounce here, that would be a great sign that the market is ready to move forward. Keep an eye on short-term holder MVRV. I do want to touch on illiquid supply shock because we haven't looked at it in a couple of weeks. As a recap, illiquid supply is the supply held by entities on chain that do not have a large history of selling. We break up entities on chain, those are individual participants, based on their inflow and outflow history lifetime. If an entity has a history of hodling the majority of their coins, they get categorized as an illiquid entity. Conversely, if an entity has a history of outflows, if most of the coins they purchase ultimately flow back out, they get categorized as a liquid entity. And illiquid supply shock, seen here on this blue line, is the ratio of supply held by hodlers, by strong hands and people who don't like to sell, versus the rest of supply. So when we see illiquid supply shock going up, it means that supply is being absorbed by on-chain entities that are not favorable to selling. And we can assume that when they buy coins, they are doing so with the intent to hold them for the long term term based on their history. We've covered illiquid supply shock a few times on this channel, and it really helped to kick off the first video for Alpha Beta Soup, where we explained the thesis of a supply squeeze that had been building during the summer. We saw weakness in price while illiquid supply shock was growing, which showed a bullish divergence in the underlying on-chain data that did not tell the same story as the weakness in price. The observation of illiquid supply shock is that it is pointed at the moon. This line of illiquid supply shock has been growing steadily since the summer, and even during this rally in October and November, it's continued to rise. More and more supply is ending up with strong hands, even as we set new highs. This group will eventually distribute. They did earlier this year. They sold the absolute top of the market, but they were also the first group to turn around and start accumulating. There has been no sign of capitulation from our illiquid supply groups so far. Just since we haven't mentioned it, the orange line here is exchange supply shock. So just like the blue line is showing supply being taken away from spenders and put in the hand of hodlers, the orange line is showing coins being taken away from exchanges and put into private custody. This value is also continuing to grow. Even as price has been going sideways in the last couple of weeks, we've been just seeing sideways above 60K, and exchange supply shock and illiquid supply shock continue to rise. This is a bullish dynamic underneath weakness in price. If it continues to play out, we had a bullish divergence earlier this year that led to a rally, and then we had another bullish divergence here at the end of September that led to a rally. Will we get this again? I'm not sure, but I am watching it. The final thing I want to touch on is the derivatives dashboard. So we have a question from one of our viewers. Thomas B asks, I understand almost all of what you show. I have a real problem understanding what is meant by open interest and funding rates, and I can't make the link between why it actually impacts the price. Is it ridiculous to ask that you do a derivatives for dummies section to show what these things are? Thomas, that is not ridiculous at all. We have covered futures a number of times on the channel, but I'd be happy to explain it again as a refresher for those who also want to know. Futures open interest, which is the chart here at the top. On the left, it's in US dollar terms, and on the right, it's in Bitcoin terms. Open interest is the total value of all of the open positions in the futures market. Here, this is the perpetual market, which is the side of futures that is governed by this funding rate that I'll explain in a moment. There's another futures market, a traditional futures market with expiring contracts, which is similar in operation to the traditional finance futures market. That futures side has more volume, and that is where the futures ETF that launched a couple of weeks exists. But when we look at futures in Bitcoin, I like to watch the perpetual market because that's where the funding rate exists and we get more visibility into the leverage in that side of the system. So open interest is essentially the standing volume of all the positions that are open. When you have high values, it means there's a lot of players in the space. And when you have low values, there's less interest. The USD value of open interest changes with the price. So when price goes up, open interest also goes up in value, which is why I like to look at it alongside the BTC version of the same chart, because it takes out the noise of price changes and you just see the flow of Bitcoin. Open interest is elevated. It's very high, which is not necessarily a bad thing, but it will continue playing a big role in the market. The funding rate here, this green chart, represents the bias and leverage in the futures market. Let me zoom out a little bit. Funding can be positive or negative. When it's green, it means that there is an imbalance of long side positions in futures. Long traders are betting on price to go up. Short traders are betting on price to go down. When you have a lot of positions opening, an excess of leverage, and an imbalance of long traders, the funding mechanism increases its premium. So when you see these values rising, what that means is that traders who are betting on price to go up are paying a premium to have those positions open. And their premium is getting paid to the traders on the short side. It's a way of incentivizing balance and encouraging people to take the other side of the trade. The way that we interpret funding is to watch its direction in relation to price and to pick out divergences. So what we've noticed in the last week, there's been a couple more liquidations. So when there are liquidations in futures, they occur when a trader has a position that is over leveraged and the cost to keep it open exceeds the amount of money in their account. They have to collateralize their positions in order for the exchange to allow them to open a contract. And they collateralize them sometimes with Bitcoin. If they are long traders and their positions get closed out, those become sell orders and their collateral is taken. If a futures trader is short, if they are betting on price to go down and they are wrong and they get closed out, their closeout becomes a buy order. In the last week, here on this November 15th, one of the key things we look for, as I mentioned, are divergences between funding and price. If you see here on the 15th, the funding rate was kind of sideways through the 12th to the 15th as price was sideways. The funding rate stayed sideways around this 0.01% level, which is essentially a flat level for the funding rate. But here on the 15th, we started to see the rate rising, which indicates more longs are opening positions, and the bias is beginning to tilt more to the long side. Now, this funding level is low, but the key here is the divergence itself, because we already noted that volume overall is very high. Open interest is elevated. And so when we see funding rising while price is sideways or going weak, the aggressors in the futures market are not being rewarded for their bias. Ultimately, price hits a breaking point, and some of these people get liquidated, which you see right here. This is long liquidations, and this is the same moment that price is going weak here on the funding rate chart. Price goes weak, these long traders are caught out, and their positions are automatically closed, which creates some sell orders and helps propagate the sell-off. This is the dynamic that we look for. When funding is very elevated, these moves can be even more dramatic. They don't always cause the sell-off. Sometimes price weakness invites some liquidations, which then encourage further selling. These two forces play against each other, futures and spot market. And so it's always important to watch them both and be aware of where they're going. When the futures market is being very aggressive and price is not rewarding them, typically someone gets punished. So I hope that helps explain a bit of how the futures market works. And if you have any other questions, feel free to ask them. So, as a quick summary, currently, futures is looking pretty steady. The funding rate is muted, OI is elevated, but I think we've squeezed out a few of the longs that we acquired over the last few days. Something to keep an eye on. Not really sure what kind of role it's going to play day to day. I feel more reactive than proactive in many cases with futures, because we start to see some of these liquidations and things on lower and lower funding rates. Earlier this year, very high funding was a clear signal that something was going to happen. But as the futures market has continued to grow and become more robust, we've seen more action with less of an extreme funding rate. Illiquid supply and the supply held on exchanges both continue trending in a bullish direction. Hodlers and people who don't like to sell continue absorbing supply and taking it away from exchanges, creating a friction between possession and the ability to sell. Short-term holders are seeing some spending. We've noted that they have spent a few coins in loss, and their profile of spending, their profit ratio, seems to be slightly declining into this weakness. But we have noted that in previous bull markets, short-term holder cost basis often tests the break-even line, and when it does, it can find a key support that pushes us into the next leg of the rally. We are watching that level here, potentially, if price were to pull back enough to test it. And that level right now is around 53K, which aligns with the top of this peak from September 7th. Will we actually test this level? I don't know, but we certainly could without threatening our overall bull thesis about Bitcoin and the current market. It's important to remember that price weakness does not invalidate our bull thesis on its own. We have to look underneath price to the on-chain supply dynamics and spending behavior to really understand where this market sits. And right now, everything is all systems go, despite this short-term weakness. Check me out on Twitter at TXMC Trades. I post a lot of charts, articles, I go on podcasts, and you can find all that stuff on my Twitter page. It's also a great place to ask me questions and interact. If you didn't understand something I explained in the video, or you have other questions, leave them in the comments to the video and I'll check them out. We'll look to make another video, maybe at the end of the weekend, Sunday or Monday, and see where things are standing. I hope you're having a great week so far. I'm going to let you guys go for now, but we'll speak again in a few days. Take care of yourselves. We'll chat soon. Cheers, friends.